a message there asking you to go ahead and continue. What I'll do for the classes where we don't meet live, okay, as I mentioned the other night, I'm not able to do it for classes that are supposed to be in person classes, but for the ones where where we're remote anyway, I don't see any problem with recording those, and then I'll post them up under the chapter to which they relate. So for today, I'm expecting that we will definitely get through chapter 1, and we'll probably make some pretty good headway into chapter 2. So sometimes you might see part of chapter 2, let's say, under chapter 1, because I'm not going to split the videos. But you'll get it that as you start to watch it, at some point we'll transition into chapter 2. But I'll typically post them under whatever chapter we started that date, and you can find the lectures there. Sometimes students like to go back and just see certain parts. You don't have to obviously watch the whole lecture again, but you may see certain parts of it and say, oh, okay, yeah, I'd like to take another look at that. So I will post them. The way I do it is I load the video into YouTube and my YouTube page, and then you can go ahead and follow the link here, I hope, unless this problem persists with the link problem. And then you should be able to watch any portion of the video you want. If when you're on YouTube, you see little advertisements on the side, sometimes I'm afraid that students think that I'm somehow pushing those advertisements. They have nothing to do with me. They have to do with things that, YouTube has decided that you're interested in. And so that doesn't really have anything to do with my judgment. That's more things that YouTube is doing automatically. Before we get started, any question logistically about anything at this point? Or otherwise, any questions?
Yeah, did you happen to see the note I sent you in chat there?
Yeah, that you're gonna have some things going on in the background. Yeah. I'm not a huge hey, turn your cameras on, guys, kind of person. I don't know. I never know what's being said about me on Rate My Professor because I don't read that. I figure any website that starts judging you whether or not you're hot is probably one I should stay away from. So if you're reading things that are saying, well, this guy makes us turn our cameras on, we don't like that or something, that's coming from when I have guest speaker. Yeah, I want the students to turn the camera on because I don't want to bring in somebody from PricewaterhouseCoopers who's making big money, billing clients for services, and then they take time, they stop that train to come and talk to us, and then they're staring at a bunch of empty cameras. So under those circumstances, I ask that you do turn it on. But since we don't have any live guest speakers this term, I'm not going to trip if you don't turn on your camera. Now, sometimes people think, oh boy, he's giving us a signal that we can just, log in and go out and, get our jogging in or something, or watch TV or catch up on the baseball game or something. That's not what that means, because I could very well call out to you and then it's going to be, where are you? And that's where you're going to get an email from me saying, hey, I called out to you, you weren't there, what's going on? So just make sure that you're following along, but you don't have to if you don't want to turn your camera on. If you do, I appreciate that. It helps me to kind of see. I have a separate monitor where I'm looking and seeing, that you guys are there and that kind of stuff. So yeah, I do appreciate somebody turning your camera on. That's great. Okay. Anything else before we get started? Okay, good. Let's go ahead then. And what I want to do is pick up with the slides from chapter 1. Okay, sorry guys, I was looking at something else prior to class here, so let me just back up a little bit. And I think we had left off about here. Okay, so I'm going to flip my machine into tablet mode, and please don't feel offended that I'm not looking at you the whole class, because I've got my tablet here, I've got a separate camera, and I do that because once I put the computer in tablet mode, you'd be staring at the ceiling if I left the camera on the main computer. So I've got the camera kind of set up over here, but I'll do my best to make eye contact once or twice during the day here as I'm going through and looking at my slides, okay, and marking them up, etc. You have these slides on Canvas. I generally recommend that you have these slides available either in hard copy on your tablet somehow, so that as I'm going through and marking them up. One second, guys. As I'm going through and marking them up, you're also able to make a few notes as you go through and want to remember something important. You can put it there on this actual slide that we were talking about. Okay, so remember, we talked about generally accepted accounting principles, and remember we said we have the FASB, the Financial Accounting Standards Board. We said that was a not-for-profit private sector entity that the Security Exchange Commission has delegated the authority to set accounting standards. So if you look at the federal statutes, 1933-34, it called out the SEC as the federal agency that sets accounting standards, but then they delegated that to the Financial Accounting Standards Board, although they do weigh in from time to time with specific requirements of additional things that they would like companies to disclose in their financial reports. But for the most part, the FASB is the entity that sets the generally accepted accounting principles. We often refer to that as GAAP. Okay, now we said that companies follow GAAP when they prepare their financial statements, and the reason we need a similar set of standards that all entities will follow is because we want to be able to compare company A to company B. We want to be able to know that they're all following the same standards. And we talked a little bit about enhancing the reliability of those reports by having auditors come in and look, and they're looking to see that those standards were followed when the entity prepared those financial statements. And we spent a little time looking at the financial filings, the 10K, the annual 10K SEC filing of Apple, where we were able to look through and see these various financial statements, the balance sheet, the income statement, statement of stockholders' equity, statement of cash flows, and then there were a bunch of note disclosures. I didn't go too far off into those, but remember they gave us information about significant accounting policies, etc. Remember that you do have that write-up that I'm asking you to do, where you pick a company and you're going to go through their 10K, their annual report, and see if you can answer certain questions that are contained there in the rubric for that project. I don't recommend that you do that right now, but I would say definitely after the first, well, the only actual exam we're going to have, our, I guess we could call it our first midterm, that'll come up covering chapters 1 through 3, that you kind of go ahead and start that project maybe after we've gotten past our first midterm. Now, as I mentioned the other night, we're going to spend a great deal of time here in the beginning with the balance sheet, income statement, and then something called statement of retained earnings, which really is a component of the statement of stockholders' equity. We'll get more into issues dealing with stockholders' equity after the first midterm, and then after the first midterm, we'll do statement of cash flows. Okay, any question about any of that? All right, good. So what I want to do at this point is see if my clicker will work. wouldn't shock me if it decided not to work, because why should anything work today, right? Of course, it would help if I turn it on. Okay, all right, so we take a look, and you can see we're going to look at financial statements here, and we're going to focus on the income statement, the balance sheet, the statement of retained earnings a little bit. But I think these are similar to what we saw when we looked at apples, but of course, much smaller, much more basic set of information. So the first one we look at is the income statement. And on the income statement, of course, we will report what? We will report our net income. Okay, so you can see net income is reported on the income statement. Okay, so how do you calculate net income? Net income is calculated as revenue minus expenses. Revenue minus expenses is net income. Where do we report net income? We report it on the income statement. Okay, and I'm saying it that way just so you start to get used as to what different accounts are reported on which financial statements. So we report revenue and expenses on the income statement, because on the income statement, we report net income. Net income is revenue minus expenses. Now, we have this statement of retained earnings, okay? And retained earnings, and the way I like to kind of do a silly little illustration of that is basically, okay, this is our income statement. I mean, not our income statement, excuse me, our statement of retained earnings. Do you know what this is? Okay, nobody ever knows what it is until I do this. Do you know what it is now?
Is it a pig?
Good. Okay, usually people get it when I do the tail, right? The squiggly tail. It's a pig. Okay. You know, and you heard the one, what did the pig say when the farmer grabbed him by the tail? You ever heard that one? The pig said, "This is the end of me." Okay. But okay, this is a piggy bank. Okay. And when we think of the retained earnings, the statement of retained earnings, we can think of it as a piggy bank. So what happens? You make income, right? You have your job, you make income, and what do? You take your income and you put it into your piggy bank, don't you? Okay. Now what happens? You try to save some of that money, you try to retain some of it, but every now and then you're going to have to do what? You're going to have to go ahead and kind of, and forgive me for where I'm putting that stopper, okay, but you're going to pull the little stopper out of the piggy bank, reach in there, and you're going to pull some money out from time to time, right? Well, in a corporate environment, we call that a dividend. Dividend is basically saying we are dividing the income amongst various shareholders. Now, of course, if it's a smaller entity, maybe there's only one shareholder who is doing what? As an individual, remember, we have a separate entity. The corporation is separate from the entity under the economic entity principle. And so what happens? The individual from time to time will
It's not open tomorrow.
Okay, was there a question? Okay, guys, I'm going to ask that you focus on the material while we're doing it. I understand you're all busy, but we can't have you, working while you're attending the class. Okay, so you focus on the material in the class, during the class. I understand that they make cell phones in a manner that if we don't pick them up and hold them every few minutes, we feel empty inside. Okay, so, if you do something like this and you go, and you put it back down, I'm not going to trip off that, but I can't have you, hacking away on your other device whatever, your cell phone while we're attending the class. That won't work. Okay. Okay, good. So what happens? We sit there and we reach into the piggy bank and take some of that money out from time to time. That's a dividend. We're dividing the earnings amongst the shareholders. And then if we what? If we didn't pull it out, we retained it. And so we end up with the ending balance of retained earnings. That will be reported on our balance sheet as the part of our income that we have saved over the years. And so you go ahead and you take a look at the next slide now, and you can see how the retained earnings then rolls down to our balance sheet. Okay, and why do we call it a balance sheet? We call it a balance sheet because it balances. So assets equal liabilities plus stockholders' equity. They say and, but it's really a plus. Okay. Now, for right now, in our class, stockholders' equity is going to be constituted of our, and again, they made me flip to another slide here, but assets plus liabilities and stockholders' equity. For right now, our stockholders' equity is going to consist of common stock and retained earnings. We will add different components of the stockholders' equity as we move along, primarily in Chapter 11. But right now, we can just think of our stockholders' equity as being our common stock and our retained earnings. And then we'll get into statement of cash flows much later after the first midterm. Question? Okay, good. So let's go ahead and let's look. And these questions, are kind of a little bit silly, but let's just work them. I'll just work them out loud here with you. I don't particularly care for these, but they're in there and it's a good chance for us to maybe open up some additional dialogue. But we say combining the activities of Kellogg's and General Mills would violate the what, do you think? You combine the activities of two different companies.
Economic entity assumption.
Yeah, right. I'm seeing is the name Moto? Is that actually your name?
No, it's Jerome. My microphone isn't working, so I have my phone on. Then using it.
Okay. Okay. No, that's fine. That's right, Jerome. Basically, we're doing what? We're saying the economic entity assumption because we separate the activities of different entities. We separate the activity of the owners from the activity of the entity. And I gave the silly example that if I had a barber shop and I had a barber chair somewhere at home, even though I own a barber shop, I would not include that chair that I have at home as one of the assets of the business unless I actually moved it into the business and started using it productively in that activity. Okay, good. How about this one? A business organized as a separate legal entity under state law. What do you think? Separate.
Yeah, corporation.
Yeah, good. I think that was Jace Gerard. Good. Yeah, that's a corporation in that what? The corporation is basically organized under the state law and it's seen as separate from the owners. So even though the corporation would be liable, say, for some bills if we ordered a bunch of, equipment and product and whatnot, and then maybe our business doesn't go as well as we thought, yeah, our creditors could move against the assets of the corporation, but they would be blocked by from coming after, say, our personal residence or something like that as part of the settlement of any outstanding liabilities. Now, often what a creditor will do when they're seeing a corporation that's maybe just getting off the ground and just starting and you're trying to get a creditor, they may actually ask you to sign some sort of agreement that they could go after your personal assets if you don't end up paying, because they're looking and saying, well, who knows if this corporation is going to be viable? And they could ask you if you were in a very small corporation that you had incorporated. They may say, well, no, we want you to sign off as yourself as opposed to the corporation. That could happen. But from an accounting standpoint, from a legal standpoint, we're looking at the corporation as a separate legal entity from its owners, and corporations are organized under state law.
Mhm.
Okay, question? Okay, good. Now, what you see here is the basic accounting equation that we will be always keeping in balance. This equation must always stay in balance. It never gets out of balance. But if you notice, it's calling out the elements that we have already seen on the balance sheet, okay? So we're seeing assets equal liabilities plus stockholders' equity, okay? Now, assets by definition have future economic benefit. Assets by definition have future economic benefit, okay? So is cash an asset?
No.
If you don't think cash is an asset, that means you think it has no future economic benefit, which means I would like for you to give me all your cash right now.
Mm.
And your answer would be, hell no. Because you realize that what? Cash has future economic benefit. You can buy your lunch with it. You can buy a car with it. You can buy anything your heart desires within the confines of the law, of course. But you can buy anything your heart desires with what? With cash, right? So cash absolutely has a future economic benefit. Therefore, cash is an asset. Good. Is a piece of equipment, say a vehicle, an asset? Yeah, vehicle has future economic benefit. If I'm a company and I have some delivery trucks, whatever, I can use those to deliver my product to my customers. So that has future economic benefit. Good. Does a building have future economic benefit?
Yeah.
Yeah, a building, we can maybe use that in our business for the next 20, 30 years, whatever. So that obviously has a longer term future economic benefit. So it's an asset. Good. Okay, so cash is an asset, a vehicle is an asset, a building is an asset. Anything that has future economic benefit is considered an asset. Okay, now our assets equal our liabilities plus our stockholders' equity. Okay, so let's say you have $100 cash in your pocket. Okay, but in the other pocket, you have a $40 cell phone bill, $40 phone bill sitting in your other pocket. Do you really own all the future economic benefit of that cash, the full $100?
No.
No, you're going to have to take some of that $100 and pay it to the phone company, right? And so we call that a liability. And I'm saying it funky like that on purpose, a liability. Our liabilities are our bills, aren't they? Okay. A lot of the vernacular we use from accounting probably comes from, 19th century England. Okay. And so you can almost picture that if you had liabilities, you could picture somebody with an English accent saying, no, all bills, right? So bills is just short for what? For liability.
Really.
They are what? They are claim against our assets, right? Okay. Now, what happens? You have that $100, you have that future economic benefit, but you're going to have to pay some of that to your creditors as a liability, right? But the $60, you still own that, don't you? That still has owner's equity, stockholders' equity of $60. Okay. So we have our assets. We have certain claims against those assets, our liabilities, but then whatever's left over that there's no claim from a liability is considered our owner's equity. Question. Okay, good. Now the next couple slides, guys, just basically go through and say what I said about each one of those assets, liabilities, stockholders' equity, but I like to keep it up on that first slide since we got the numeric example there. Okay, just remember that for right now, our stockholders' equity is what? Common stock, and the piggy bank, what's left in it anyway, the retained earnings. Okay. All right, good. Now, this next slide is a little bit sloppy, a little bit silly, and sometimes I think about trying to, make this thing a little more professional looking, but every time I start to do that, I realize, well, it's not getting any more clear by sitting there. Oops, sitting there. Yeah, I just want to block that out. By sitting there and making it any more pretty. So I'm just going to stick with it the way it is here. Okay. So we're just going to do a little example. We're going to say we're going to start up a little business here. Let's say we're sitting in our house and we don't have any money. Are we happy? No. People say, oh, well, money doesn't make you happy. Who says that? People who have money, right? Okay, so what happens? You sit here and we don't have any money, so we're not happy. So we're figuring out, how can we get some money in our pocket, right? So we look out in our backyard and we see, oh, okay, we have a lemon tree. And we look at the tree and it's got 20 lemons on it. And we're saying, wow, we paid $20 for that lemon tree. It's got 20 lemons on it. So we have value there. We have future economic benefit. We could take those 20 lemons and sell them and make some money. And then we'll have money in our pocket instead of just these lemons that are growing on this tree, right? So what do? We sit there and we say, well, we want to get some. Remember, corporation gives us some sort of limited liability. We don't want somebody to buy the lemons and choke on a seed and then sue us or something. So we go ahead and we say, or if we're gonna, borrow some money or something for the business, we want to protect our personal assets, right? So we're going to take the lemons, okay? We're going to put them into the corporation. And in exchange for the lemons, which have value that we put into the corporation, we will take that stock and we will hold that stock for our value of lemons that we put in the $20. Okay. Now we have this lemons that are now the property of the corporation. To evidence our ownership of the corporation, we took back $20 worth of stock. Now, just stop from a second from this example. I have $20 worth of stock, right? And then I go to some folks in the class here and I say, look, I'm going to start up this corporation. I've started this corporation and I'm going to have the most fantastic lemon company you've ever seen. And I've got all these great ideas, And so I tell you that if you want to, you can just basically take over the business from me right now. What I'll do is I'll sell you the stock, you take over the business, I'll give you my concepts and whatnot, and then you'll be the one that'll actually run this great idea, okay? So I paid $20 for the stock. I paid $20 for the stock. I don't know if you can see that. That says $20 on it, right? I paid $20 for the stock, okay? But now I'm going to sell it to you. And I'm going to ask you for $25 for this stock. It happens, right? When the stock is initially issued, it has a certain value to it, but then as time goes on, maybe you could sell that for a little more, right? So I take that stock, I sell it to you, you give me the $25. Now you own the stock. You own the stock. Has any more economic value come into the corporation at this point?
No.
No, no more value has come into the corporation. We've just simply traded the stock and now we have new owners. You've taken that over. So when the corporation issues the stock, right? It sits there and it shows that we have what? We have $20 worth of lemons and $20 worth of stock out there that are being held by the owners, right? And you can see that right on the balance sheet, and the personal identity of the owners is of no consequences to the value of that stock. So now that stock is selling for what? $25 per share is pretty much what the market is saying. So when a corporation issues stock, they generally don't issue all of their shares in one chunk. They have some shares that they've issued, but they have some shares that, even though they're authorized to issue, that go above and beyond the number of shares that are outstanding at any point in time. So let's say the corporation goes ahead now and issues, let's say this stock is $20 per share. So they issue one more share of stock, but they issue it for 25. At that point, what? Let's say it was cash. We get $25 more of cash coming in, right? So now our assets would be what? The lemons plus the cash, 45. And we would show what? We would show in our stockholders' equity that we have the original 20 plus an additional 25, 45, the balance sheet would still balance, right? But we only recognize the difference in the market value of the stock if we issue additional shares when the market is saying that that stock is trading at a higher value. Question?
Wait, yeah, I kind of do. So in the example that you just gave, the $25 that you sold for a stock, your total company assets would be the $20 in lemons plus the $25 in stocks, which would be $45 in assets, right?
Correct.
Okay, cool. Just wanted to make sure that I made sense.
Right, and the equation would stay in balance because now the stockholders' equity would be 45, the original 20 plus the additional 25 we just issued, right?
Oh, okay, I see. That makes sense. Awesome, thank you.
Yeah, okay. Okay, good. But I just want to riff off from the example on that for a second, because sometimes students think, that as the market value of the stock changes, that we should be reflecting that somehow on our balance sheet, only if we issue additional shares, right? Whatever we originally issued those shares at, it stays like that, right? Even though the stock may be out there trading for $25, the fact that one person handed their stock to another person is of no consequence to the value that we're showing for the stock on the balance sheet, right? Okay. Okay, good. Now, what happens? We go ahead and we have these lemons and we're thinking, well, of course, we want to sell the lemons for more than $1 a piece because that's what they cost us, right? We paid $20 for the lemon tree. The lemon tree had 20 lemons. That's $1 each. We want to sell it for more than that because we want to make a profit. So we have to differentiate these lemons. Can you think of some ways of making these lemons special so we could sell them more for $1 a piece? And don't talk to me about lemonade. It's just the lemons, because if it's lemonade, then I'm going to have to get some water and some sugar and some spices, whatever. Just the lemons. Is there a way to differentiate those?
You can say that they're organic and super healthy.
Okay, maybe I'm saying they're organic and super healthy. Of course, then all of a sudden we have FDA wanting to say to us, well, are they really super healthy? How can you prove that? And our attorneys start to tell us, well, you might want to stay away from super healthy, but okay, organic, we grew them in our backyard, right? Okay, but then somebody might say, well, was the tree actually organic? I mean, you grew them in your backyard, but the tree wasn't growing, so we're going to go with this. We're going to say, okay, we're going to sell them as spinning lemons. Okay, these lemons spin better than any other. So we sit there and we start spinning the lemons, and people look and go, look, spinning lemons, look at how good they spin. Okay, I'll pay you $5 per lemon, whatever. Okay, I'm being silly, but we differentiate them. Okay, and we sell 5 lemons, and we sell them at what? And guys, you can see it right here on the screen. We sell them at what? At $3 each, right? Now, when we sell them at $3 each, and if we sell 5 lemons, then that means that we are generating what, $15 of revenue. 5 times 3, we got $15, and we call that revenue. Okay. Accounting has somewhat of a connection to religion. Okay. So revenue, we reverend our revenue, and you say, really? No, come on. Accounting has no connection to religion. Well, when we first start hearing about the accounting methods that we're going to learn in this class from a historical standpoint, you go back to 12th century Venice, and there was this Catholic father named Pacioli, Padre Pacioli, that they call the father of accounting. And what he was doing really in his journals was writing about a lot of things that were going on in 12th century Venice. Venice was its own republic in those days, and there's a lot of commerce going on there. And so he started writing about business activities. And one of the things he wrote about was accounting, this thing called double entry that we're going to be learning a little bit more about here today. Bookkeeping. So he wrote about that in his journals, and there's this sort of connection to religion and accounting. So we call our revenue, you worship your revenue, don't you? We call our revenue when we earn in our business, when we earn in the line of business that we're in, we call that revenue. Okay, so we've got this, what, $15 of revenue. We sold 5 lemons at $3 each. But we have to recognize the cost of those lemons. And so those lemons did what? They cost us $1 each, right? So we take the 1 times the 5, okay? That gives me $5 cost of goods. I'm putting lemons in here since we know it's lemons, cost of goods sold. And I am left with something called gross profit, okay? Now, in most businesses, gross profit is an important number because what? We have to pay our suppliers for whatever it is that we're going to be selling, or we have to incur the cost to manufacture whatever it is that we're going to be selling. And those costs are not always necessarily in our control. For example, I was just seeing something about the cost of computer chips right now is going up, and because there's a shortage, and it's significantly impacting the cost of computers and some other type of electronic devices of those nature. And so what's happening now, we're seeing the cost of certain materials go up, and it's just a little bit hard for a company to control that at any point in time. So we want to see, hey, are you generating enough revenue to cover costs that, yeah, you probably can control those a little bit, but you're also at the mercy of the market and whatnot. And so we want to see what you have left over after you have paid for whatever it is you're selling. Okay. And so we call that gross profit. Now, nobody looks at gross profit and says, hey, you know, you might want to thin down a little bit, mix in a salad. Everybody says, eat gross profit, eat, get as fat as you can, right? We like a nice chubby gross profit that's sitting there because we need that to then cover our operating expenses. Okay, so what happens? We look at our lemon tree and we see that, you know, we picked the lemons off of it, but it's looking a little tired because we pulled all the lemons off of it. So we say, uh-oh, we better keep that tree healthy because that's going to help us to generate our revenue. So we go over to the nursery, you know, where they sell all kinds of farming products, and we grab a bag of fertilizer. And we take that bag of fertilizer up to the counter and we give the guy $7 for the fertilizer. Okay. So what happens? Now we take the fertilizer, we take it back to the lemon tree, and we dump it on the ground next to the lemon tree. Okay. So that it'll help the lemon tree grow. Is there any more future economic benefit associated with that fertilizer? And guys, ignore agricultural accounting, because I'm sure in agricultural accounting, there's a way of recognizing the value of something as it grows or something. But just from a very novice standpoint, if you dump something on the ground, does it have any more future economic benefit?
No.
Not really.
Yeah. Now, there's no more future economic benefit. I dumped it on the ground, right? So what happens? The future economic benefit has expired. The future economic benefit has expired. And I'm saying it funky like that for a reason, because notice we're calling it an expense. So we're calling it fertilizer expense. I didn't call it out as expense, but this would be an expense. I didn't say it there. But fertilizer expense, because the future economic benefit has what? Expired. So I had this gross profit. I take off the $7 I paid for the fertilizer, and I have net income of what? $3. Not bad for, I don't know, is this a year's worth of work? Okay. And so I end up with this net income of $3. So I have prepared, what would you call this statement right here? What would you call that?
Income statement.
Good. There's my income statement. Why is it the income statement? Because it shows net income. How do we calculate net income? Revenue minus expenses. Although we did have that stopping point for our gross profit. So cost of goods sold really is sort of like an expense, but we don't call it an expense because, and it's a nerdy accounting thing. If I sell you lemons, I'm passing the future economic benefit of those lemons onto what? Onto you. So we call it a cost of goods sold, but in terms of its impact on net income, it has the same effect as an expense in that it reduces my net income, right? Down from my revenue of 15 minus the $5 of cost of lemons sold, left me gross profit of 10 minus the operating expense here for my fertilizer, $7 leaves me net income of 3. Is there a question? Okay, good. So now I go and I'm ready to prepare my balance sheet, okay? And when I prepare my balance sheet, let's take a look. I have what? I started out with 20 lemons, didn't I? $20, but didn't I just sell 5 of them? I sold 5, so I only got 15 lemons left. 15 lemons at what? $3 each. So now I'm left with what? $15 worth of lemons, right? I had 20, I sold 5, I got 15 left. I'm valuing them at $1 a piece. That's 15 lemons, okay? Now, let's figure out my other asset now, which is cash. Sorry, guys, I'm annoyed by something from Zoom that's not letting me see what Jared? If you got a question, guys, just jump in and interrupt.
Okay.
Yeah, go ahead, because I might miss the
So the
answer.
way that we account for the lemons is always on a cost, like what it cost us initially, not what the market value would be or what we could sell them for.
Well, there's a concept called lower of cost, or and just to make it a little more simple, because it's not quite this simple, but there's a concept called lower of cost or market for inventory, and you're supposed to value it at that lower of the cost or the market. Okay. So I'm assuming here that the cost of the lemons is lower than the market. If for some weird reason, let's say the market for the lemons drop down to say 75 cents per lemon, then technically under accounting, I would have to lower it to that lower market value. But that's really kind of beyond the scope of where we're going to go in this class. But do keep that in the back of your mind that you do need to write inventory down to a lower market if the market falls below the cost. In this case, I'm assuming that the value of this inventory has not fallen below its cost. You never write it up to a higher market. You do not write it up to a higher market. That's not allowed. So if the lemons we can see the lemons are selling for $3 a pop, right? But we do not write it up. We only can recognize the revenue that's generated from that when we exchange it to a third party, right? In an arm's length transaction. That's when we generate the revenue. And that's how we would recognize the fact that we were able to generate revenue by the fact that somebody paid more. But as long as you're still holding that inventory, right, you cannot write it up to a higher market. You must write it down to a lower market. If the market is above the cost, then you leave it at cost, which is what we've done here.
Got it. Thank you.
Okay. Okay, good. Okay, all right, good. So good question. So we sit here and we have these lemons, $5 each. I mean, excuse me, $3 each, 15. Stop. $1 each, right? That's what that was our cost. $1 each. 15 lemons, $15. Now the cash, what happens? Well, we had, and I'm assuming we sold those lemons for cash of $15. So we turned those 5 lemons that we sold into $15 cash. But then we reached into that cash and we paid the nursery owner, the fertilizer guy, $7, didn't we? So we're left with $8 of cash. We got 15. We took 15 of that money out of our wallet and handed it to the cashier at the fertilizer place. So we're left with $8, aren't we? Okay, and I look at the class because for some reason, I sometimes have trouble getting my class to understand that. And I'm always a little confused because I just think of your wallet. You sold something, you put $15 in your wallet, but you had to buy the fertilizer. So you took $7 out, you're left with 8, right? Okay, so we have $8 left of cash. So the lemons plus the cash gives us what? Gives us, we don't have any other assets, gives us total assets equal what? 23, 15 plus the 8. The lemons have future economic benefit. The $8 that we're left with has future economic benefit. The stock, hey, we only issued the $20 worth, right? We didn't issue any more shares. So that $20 of stock just sat there in the hand of whoever we issued it to, right? Nothing more came into the corporation. So the stock is still out there in the hand of whoever that other entity was that bought our stock, right? Our single owner, or maybe our single owner has now handed it to the people that are actually going to operate the business, whatever. The corporation did not issue any more stock. So that $20 is still there. And then our retained earnings, and let's just go ahead and see if we can off to the side here real quick. What's this?
The pig.
There's the piggy bank, okay. And since we first started the business, the beginning balance was what? What's the beginning balance in your piggy bank before you do anything? What does your piggy bank have in it before you earn any money, huh?
Nothing.
Oh, before we earn.
I'm not talking about the piggy bank that your grandmother gave you and said, here's $5 in there, keep going. I'm talking about the piggy bank that you must put everything into. If you haven't made any income yet, does your piggy bank have any money in it?
No.
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 Okay, so the beginning balance is what? Zero.
0.
And then where do you put your net income? In your piggy bank. So we'll add net income. What was my net income?
20.
3. Okay. I haven't paid any dividends, so there's nothing to subtract. So my dividends are 0. So what's the ending balance in the piggy bank?
3.
Ending balance in the piggy bank, good, is 3. I put my retained earnings where? On my balance sheet, don't I? Isn't that where the retained earnings goes? On the balance sheet? And so now I have my stock plus my retained earnings gives me stockholders' equity. I don't have any liabilities. gives me stockholders equity of 23, doesn't it? I'll abbreviate stockholders equity SHE here. And so I have what? I have stockholders equity of 23. Does my balance sheet balance?
Yes.
Does my balance sheet balance? Yes, it does. Did any rabbits jump out of any hats? Was there any magic tricks done here? No, it was simply, hey, I took my lemons, I sold them for more than their cost. I incurred some expenses of fertilizer. I increased my wealth by $3, didn't I? By this whole set of activity. And I represent that by showing, hey, now I've got retained earnings of 3, and I've got this stock out there that represents the original stock I issued at 20. I've increased my wealth by $3, haven't I? Not bad for a first year of business. A lot of businesses lose money their first year, don't they?
Yeah.
Okay. Question.
I don't know if I misheard you earlier, but I thought you gave the stock up for $25.
Well, I sold it to somebody else for $25. I had the stock. I'm John. I had it for $20, and I gave up ownership in this business. I'm going to move to Hawaii after I sell this stock. I sell it to you. You give me the $25. I go to Hawaii, don't I? I'm gone. I have no more involvement in this business.
Yeah,
Does any more money come into the corporation?
no,
So it still showed $20, didn't it? It's just that it's showing, hey, now we have different owners, don't we?
got it. Okay.
Yeah. Okay. Question?
So I got a hypothetical one. Let's say we take Jerome's like assessment and it, like the lemons dropped to 75 cents.
Mhm.
Would it make, so like now your assets wouldn't equal your stockholder equity, right?
Well, we would have to show a loss.
Oh, show a loss. Okay.
Yeah,
Okay,
we
I
would
see.
show a loss on the income statement, okay? And there's two different ways of doing that. If that drop is not significant, not really material, what we would do is we would put that decrease in value and show it as an increase in our cost of goods sold. Right? So even though we didn't sell those lemons, we had a drop, and we would treat that as a cost of goods sold if it's not a big giant drop. And of course, the lemons would be worth less, and our net income would be less, and so the balance sheet would balance itself out that way. Sometimes if an entity has a significant event that caused its value to drop significantly, they would want to call that out as a separate line item on the financial statements, and they would call it on the income statement. They would call it loss from devaluation of lemons, so that the users, remember, we're preparing financial statements for investors and creditors, and we're trying to prepare the information in a manner that will allow them to make good credit and investment decisions. And we don't want it buried if it's a big number in the cost of goods sold, because then they would lose visibility to that. So then we could potentially show that as a separate line item saying loss on the value of inventory. Bottom line, it'll have the same effect to reduce net income, reduces net income, and that will then reduce my retained earnings, thus keeping the equation in balance, that as that asset has come down, so has my stockholders' equity in this scenario.
Gotcha. Okay. Thank you very much.
Mhm. Okay, good. Question? Okay, good. Now we're going to go into year 2, right? We had a successful year 1. You can see on the screen now, we've got our year 2 situation. And now, sorry guys, I'm always chasing the Zoom button around here as I go from slide to slide. But now what's going on is we are going to sell more lemons in year 2. And last year we sold 5. This year we sell 7. We're selling the lemons for how much a piece?
$3.
$3, good. 7 times 3 is 21. The lemons cost us $7. Okay, good. So 7 times 1 is $7. Our gross profit is 14. And now we're going to go ahead and we're gonna, if you have a successful business in year 1, you'll probably do what you did in year 1 and year 2. So we go to the fertilizer store and we're going to pick up a bag of the fertilizer that costs $7. But this time when we walk in, the fertilizer store owner, the nursery store owner says, "Aren't you that lemon guy? You're here last year. I hear you're an up and coming lemon provider. Is that true?" And you say, "Well, yeah, as a matter of fact, I am that person," right? And so guy says, "I'll tell you what, you don't have to pay me right up front. I'll bill you. I'll let you pay on credit. You can pay me next year. Don't worry about it. Just pay me next year. Don't worry about it. I'll bill you. You pay me next year." Okay. So I say, "Well, thank you very much." And I take the fertilizer out of the store and I take it home and I dump it on the ground next to the lemon tree. Okay. Does that fertilizer have future economic benefit? It does not. I dumped it on the ground, didn't I? I dumped it on the ground. So I still show it as an expense, right? It's still expired. There's no future economic benefit. It's an expense. And I still owe the guy the $7, don't I? So now I have a bill, a liability. Okay. So what happens? I sit here and I have net income of 7. Okay. Now let's figure out the cash. My cash started with what? Was it $8?
8, yeah.
Last year's ending balance is this year's beginning balance of cash. The cash started with 8, didn't it? And then I sold what? I sold lemons and I generated $21 of cash. Sold
Mhm.
those for cash. Did I spend any cash? Did I spend any cash?
7.
I thought the
No.
guy said I didn't have to pay him till next year.
Oh,
Did I spend any cash?
nope.
Nope, didn't spend any cash. So my cash is now what? 29, isn't it?
Yeah.
Didn't spend any. Guy said I can pay him next year. The lemons, I started with 20. I sold what? I sold 5 the first year. No, I'm sorry. How many did I? No, I lost track of it. Stupid lemons I sold. I sell 5 the first year. 5 the first year, 7 the second year. 5 plus 7 is 12. Started with 20, so I've got what? I mean, I know these lemons are getting a little stale here by now, but don't worry about that. I've got 8 lemons left, don't I? Started with 20, sold what?
5.
5 the first year, sold 7 the second year. Is that 8?
Yes.
Okay, so I've got what? I've got 8 lemons left. Okay.
Mhm.
And so I add my cash plus my lemons. My total assets are 37, aren't they? That has to equal my liabilities plus my stockholders' equity, which is my common stock and my retained earnings. This is my stockholders' equity, right? SHE is stockholders' equity. But I do have that bill now, don't I? I still got to pay that guy. Even though the fertilizer got dumped on the ground, I still got to pay him, right? So I've got a bill of $7. My common stock is still what? Still 20. I haven't issued any more stock. That stock could be being traded all over the world outside of the corporation. The corporation has nothing to do with that trading once they've issued the stock, right? People do whatever they want. But now my retained earnings is going to have what?
Mm,
Beginning balance of how much? Ending balance was 3.
3.
So beginning balance is now what? 3. Where do I put in my piggy bank?
Net income.
I'm gonna draw the piggy bank one more time here. Put the ears on it anyway. Okay, so I have to add my net income. How much is my net income?
7.
That's on the income statement. That's 7. Good. And if I don't have any dividend is 0. So the ending balance in retained earnings is going to be 10, isn't it?
Yeah.
And I report my retained earnings on the balance sheet. So my retained earnings is what?
10.
Is 10 now. So if you take the 7 plus the 20 plus the 10, does that equal 37?
7.
20 plus 7 plus 10, does that equal 37?
Why is it plus 7 if it's a liability?
Because assets equal liabilities plus stockholders' equity.
Got it.
Assets equal liabilities plus stockholders' equity, right?
Yeah. Yeah.
Okay, so 20, and guys, let me give you just a quick point here. Sometimes it sounds like I'm being an ass when I answer your question, and I don't mean it that way. Sometimes the answer is what I'm telling you, and it sounds like, well, can't you be more, friendly about it than that? But sometimes it's not that I'm not being friendly, it's just that is the answer. Assets equal what? Liabilities plus stockholders' equity. While you're kind of getting used to some of the language, it sounds like I'm being, like Mr. Spock up here about things, but it's just kind of, that's just how it works. Assets equal liabilities plus stockholders' equity. So does the balance sheet balance?
Yeah.
Did you see any magic tricks? No. It was simply what? Following through, taking my net income, rolling it into my retained earnings, keeping track of my cash and whatnot that led us to make this thing balance. Question.
What did you mean by COGS, by the way? What does that stand for?
Cost of goods sold.
Oh, cost. Okay, I see. So 7.
Yeah, and I apologize for the sloppiness of this, guys. It's a little bit sloppy just because I did it one day in class, and then I realized, well, heck, I taught accounting only to CPA candidates for, I've been doing it for 26 years, and around the time that I started teaching to introductory to college students who hadn't had any previous exposure to accounting, I had been teaching the CPA for like 20 years. And so I walked in, and I was like, used to teaching CPA candidates, and all of a sudden, someone asked me, well, why do they call it a liability, And so one day I kind of had to stop and do this. And then I just realized actually the sloppiness of this kind of helps a little bit to kind of, just show how you can quickly do something like this to understand the way this stuff all flows. Now, what happens? We've got cash sitting here of $29 sitting in the corporate accounts, don't we? The corporation has $29, not the shareholders. All they've got is a stupid piece of paper saying that they own this business, right? But they don't have cash in their pockets. So I don't know. I decide, I want some pizza. So what do? I go and I reach into the piggy bank, and let's say I pull out, I don't know if you can even get pizza for $1, okay? But let's say I go ahead and I grab $1 out of the piggy bank. So what do? We subtract that as a dividend. We've now divided the earnings, and that dividend is now what? $1. That means that the ending balance is now $9 in the retained earnings, isn't it?
Yeah.
So I go ahead, and you can see I've given this example a couple different times. So I go ahead now, really, are you really not gonna let me erase? So I go in, and now this balance and retained earnings, you can see I've had to write that a couple times. The balance and retained earnings is now $9, guys, right here. It's $9. Just bringing it over right here. We now got the $9, but my cash is no longer 29. It is now what? I had 29. If I pulled a dollar out of the
28.
corporate accounts, it's now what?
28.
28. So 28 for the cash. Guess I'll write it up here. 28 for the cash plus the 8 for the lemons means that my assets are now what? 36?
36.
Okay, good. And 7 plus 20 plus 9, is that 36?
Yep.
And the balance sheet still balances, right?
Yeah.
Okay. Question.
Could the store owner say that the price is no longer $7? It's now $10 since like your business is doing so well. Would that do anything to our books if we technically didn't pay for it at the time of purchase, so to speak?
Oh, Judge Judy wouldn't allow that. Go ahead, take me to court, owner, a business owner, nursery owner. Take me to court and tell me that I agreed to pay $7 and now you want me to pay some amount more. Judge Judy would tell that store owner, are you out of your mind? Sure can't tell this person when you had a deal. Now, if I signed a contract with this guy that said, hey, as you know, my business does better, I'll give you more money, you know, if that was the deal, then yeah, then he could enforce that. And at that point, what I'd have to do is increase the amount of that liability and recognize that as part of my expense on that fertilizer, right? Because it didn't cost me 7, it cost me say 8 or whatever.
So we don't include that at the time we picked up the fertilizer. We do that when we do our books and everything, right? The $7.
Yeah, if we had some sort of contractual commitment that was going to increase that liability, then we'd look at the end of the year, essentially when whatever our reporting date was, and say, well, okay, there's been a change in the value of that liability based on some contractual arrangement. And so at that point in time, I would increase the amount of that liability and take that expense.
Okay, makes sense.
Yeah. And, you know, there's all kinds of different contractual things that you can get into that we won't really touch too much in this class. For example, there's a situation where, you know, maybe they let me lease an asset. And when I lease the asset, I show that lease obligation is a liability. But if there's some sort of, you know, provision in the lease that if I make certain amounts of income, that'll change. They call that a lease kicker. And then if I achieve those thresholds, then I'll have to take the expense for that lease kicker, et cetera. And there's a whole bunch of different things that we can do, but that's really beyond the scope of where we'll go in here. Question?
I actually have a hypothetical question. So let's say I'm starting like a startup in like technology, right? And I'm doing some research and development. And, you know, I have this really good idea, but I don't have a product yet. And, you know, I need some money. I need some funding money, right? How would I like know like what my owner's equity would be like from the beginning? You know, we said like 20 lemons is $20. So your owner's equity is $20 per share. But in this case, like I just have an idea and I need money to run more ideas or more research on it. How would I price that in terms of owner's equity?
Now, when you say you have an idea, are you talking about a cloud over your head?
Maybe not. Let's say it's a more like realistic idea. Like I say, okay, I'm
No.
developing, I don't know.
No,
an
I'm not
app.
talking about realistic versus not. Let me ask the question differently. Have you spent any money in developing this idea?
Oh, I see. Let's say no, I just spent my time. Let's say that.
You spent your time as an employee of the corporation, or you spent your time before you formed the corporation, just thinking about it, looking at, the sunset.
Oh, okay. That makes a difference. Let's just say I did not open a corporation or anything. It's like an idea in my head.
You've got this idea in your head. Okay. So if you've got an idea in your head, that has absolutely no value.
Oh, okay.
As
Okay.
far as, hang on, as far as the financial reports are concerned. So you would have revenue of 0, expenses of 0, net income of 0, assets of 0, liabilities of 0, and you would have stockholders' equity of 0.
Right.
Let's say you put some cash in the corporation. Now you'd have cash of 20, you'd have common stock of 20, but you'd still have revenues, expenses of 0, right? Now, you look at that and you could then go to potential investors and you could provide certain projections and whatnot to them that would compel them to go ahead and still want to buy your stock, right? So they go ahead and they give you, $10 because they like your idea, what you projected your idea is going to do. No historical results at all. So nothing on the financial statement. So now we've got cash of 30. We've got common stock of 30, revenue 0, expenses 0, net income 0. Now you start to go in and let's say you spend $5 to actually start to put these ideas together. So you hire some, IT people, they're going to help you, build this idea, whatever, right? And you spend $5 on it. US GAAP says that you will expense that $5. You do not treat it as an asset. It is an expense because you have not, you really don't have a product yet at this point, right? So any research development that you spend is an expense. So now you'll show revenue is 0 because you don't even have anything to sell yet. Expense is 5. Net income is a negative 5. So now we've got a negative retained earnings, don't we?
Yep. Mhm.
We've got a negative 5 in our retained earnings, and our balance sheet still balances because we spent $5 cash. We've got the stock. That means that we've got $25 of cash. We've got the common stock of 30 and a negative retained earnings. So our stockholders' equity is 25, isn't it? Balance sheet still balances. Now you're thinking, now my potential investors are going to start getting the chills because they're seeing the situation go down, not up. But analysts look at research and development differently than they would say an administrative expense, because they understand that that's money that you're spending, even though it has to be shown as an expense. They understand that that's money you're spending towards the development of a new product that eventually you're going to have a product to sell, and we're going to start seeing revenue coming in and positive net incomes down the road, right? Okay. Now, if you don't believe that such a scenario exists, I would invite you to go pick up Tesla's financial reports and go back a few years in which you saw negative net incomes, and the stock values continued to go up. But it wasn't going up based on the financial results as much as it was what they understood was going on with the company and what would be coming down the road in terms of growth. No pun intended when I say Tesla. So, so research and development is expensed, and it is looked at though a little bit differently than say an administrative expense would be on the income statement, because even though we treat it as an expense, the kind of, and I say wink and a nod, there's no shenanigans, the kind of, understanding is that, well, even though US GAAP says I have to expense it, that has the potential to parlay into, some future economic benefit, even though we treat it as an expense. Now, before you jump in with your next question, I just want to point out, and I'll get you in a second here, Jared. Now, under international financial reporting standards, which we don't talk much about in this class, but I think it's worth noting here at this point, that under IFRS, they have said that you should expense the research, but if you get to the development stage, you can actually show the development cost as an asset. But that is under IFRS purposes. And then one more point, Jared. If let's say I go in and I acquire all of the stock of a company that has some research and development in place, and after I have assigned all of my costs that I paid for that stock to specific identifiable assets, I get to start assigning some of that value to something that we call intangible assets. And at that point, I may say, well, you know, the reason I paid more than the fair value of identifiable assets like buildings and cars and that sort of thing is because of this research and development. Then they would have let me assign some of that cost that I paid for the company to the research and development, and I would have a research and development asset on the books at that point. Or let's say I didn't acquire the whole company. Let's say I just came in and I said, hey, I just want to buy this research, and I buy it from you. Well, now there's been there's been an arm's length transaction between two unrelated parties. Now I can put that research and development that you started, I can show it as an asset because there's been a fair exchange of value there between two unrelated parties. Okay, let me stop. Jared, did you have a question?
I think it was addressed. I was trying to determine, so the value of an intangible asset obviously has no hold over your common stock out, but it does affect overall the stockholders' equity in the event that you're spending money to get to that intangible thought, idea, asset. Any money that you spend out of your existing assets, if that makes sense.
Well, let me answer that question differently. The only way you record the value of an intangible asset on your balance sheet is if you acquire it from somebody else. So you always expense the cost of developing an intangible asset. There is no intent. If you see an intangible asset on somebody's books, it's not because they developed it. It's because they bought it from somebody else. So somebody comes in and buys the research from me. Let me give you an example. The classic intangible asset, goodwill. Goodwill is, I say, the classic intangible asset because it's the most intangible of the intangible assets, right? You go to a restaurant, say it's a special day, and your significant other brings you to this restaurant and the place is a dump. You look around, the equipment's old, the seats are busted, and you think, I thought this person really cared about me. Why did they bring me to this dumpy restaurant, right? And then you eat the food and you're like, oh, my heart, they must really, not because the food isn't healthy, not a heart attack. You say, no, they really do love me. Wow, this is great. And so you look around at all the equipment and stuff, and you say, I'd say the equipment in this place is maybe worth $50,000. So you call the owner over and you say, hey, look, I'll take this whole thing off your hands for $50,000. And the owner says, security, get this person out of here. Okay. Now you say, okay, wait, don't throw me out. Look, I'll give you $1,050,000 because you know that there's going to be customers coming to the door. So the guy agrees to the $1,050,000. What happens? Even though that owner had only shown assets of $50,000, when you acquire that and you now prepare your balance sheet for that company, you would show $50,000 of assets, but $1 million of goodwill because you acquired that from a third party. So the only way an intangible asset shows up on the balance sheet is if you acquire it from somebody else. You cannot create value of an intangible asset on your own. You have to buy it from somebody else. Even though you have that goodwill because people know when they come, you can't create goodwill. You can't make goodwill gooder. And I know that's not proper English. After you buy the restaurant, you can't say, well, you know, what I'm going to do is I'm going to, you know, do this whole little light show out in front of the place, and that's going to create even more goodwill. Let me make the goodwill gooder. Can't do it. It stays at that $1 million. Goodwill can only go down. What does that mean? Let's say one day you're not being careful and you dump some lens cleaner accidentally into this one of the, you know, recipes, and a bunch of people come out. Oh, now you've done what? You've impaired the goodwill. If you impair the goodwill, then you got to write it down. You can never write it up. So you can't create an intangible asset. You can't make it better. You can only acquire value of that intangible. And so if you look at a company that has an intangible asset on their balance sheet, that means they acquired it from somebody else. And you often see that with corporations that are buying up other corporations, and they're buying them because they're trying to get that research and development away from them so that then they can continue to, you know, enhance their product or make new products, that kind of thing.
So if we go back,
Yeah, go ahead.
if we go back to, I think it was Corey's example of R&D and this new great idea that he's got. The only time that asset is ever assigned value is once the money is spent to physically create it, manufacture it, whatever it may be.
Well, we start generating a product inventory, let's say, then yeah, if we go and we spend money on actually developing that product, but we're not putting that cost in the research and development into inventory. Once we actually have a product, right now we're spending money on what? On steel and rubber and wires or whatever to make that thing, aren't we? So we would capitalize the cost, put on the balance sheet the cost to develop the inventory. But any money that we got, that we spent to the point of, and I'm kind of making it a little simpler, but any money that we spent up to the point of where we were able to begin production, that's all expensed. Once we can begin production of an actual product, then yeah, any materials, any labor to actually develop that product, any overhead costs associated with developing that product would be part of our inventory, right?
Got it. Thank you.
But any cost that got us up to that point, and again, I'm simplifying it a little bit. I'm simplifying it. There are certain things that before you begin production, they'll let you capitalize, but I don't want to get into all that right now. But any cost to get up to the point of production for our purposes right now, that would all be expensed. And it's only after we begin production, again, simplifying it, would we start to put some cost on our balance sheet in the form of inventory costs. Sophie, did you have a question? I saw a hand flash up there for a second. I think I did.
Yeah, I was just wondering, because you said if you pay money for research, that's an expense. But an expense is that it's no more future economic benefit. But wouldn't the research give you an economic benefit, maybe? So
correct.
it can turn into an asset.
Correct, but what FASB for US GAAP determined, they had come up with, it was like their second statement. Remember I said FASB was created in 1973, and in for their second statement, okay, they looked at research and development, and that's held ever since then. That, remember, we've got the Great Depression over our heads all the time, right? And so what they're saying is it's a problem if you let companies subjectively say, look at the value of my great idea, it's gonna do all this. and you put it on the balance sheet, and then here come investors going, wow, look at all that future economic benefit. Meanwhile, you're a maniac. There's no way that that thing's ever going to come to fruition. So FASB said, hang on, guys, we're not going there. We're not going to allow you to put that on the balance sheet. We understand you're a genius and it's going to have future economic benefit, but until you begin production on your great idea and you start spending money on the production, or some other fool comes along and buys that, because now we're assuming, and when I say some other fool, we assume that the market has perfect information, right? And that there's an understanding as to the value of what you're doing. So if a third party gives you cash or some other consideration for your idea, now it has value, and the purchaser can put it on their balance sheet because they paid for it. They gave up another asset to acquire that asset. Or maybe they issued stock. It doesn't have to be an asset that they gave up. They could give us stock in their company in exchange for our idea. But as long as they gave up something of value, then you can bring it on as an asset. There was something else there. Again, IFRS says, we're not going to go that hard. We'll make you expense the research, but you can capitalize. And when I say capitalize, put on the balance sheet the development. So they've taken a different approach, a less conservative approach, IFRS has. You know, one time, just a quick story here, I was asked to go, this is before I started teaching at the university, when I was mainly just teaching for Becker and working for GAO at the same time, Becker, the CPA review course. Somehow somebody convinced the staff at Cal State Los Angeles that I should go and brief them on IFRS. And I stupidly said yes. And then as I'm preparing for that presentation, I'm realizing, why am I briefing university professors? What the hell? Why did I say yes to this? So I started getting a little nervous. This is university professors, PhDs, and I'm going to walk in and brief them on IFRS. So I've got to bring something different, you know, than what they normally would think about here. So what I started looking at, well, has Congress said anything about IFRS and the potential that the US would flip over to IFRS and stuff? And sure enough, I ran across, discussion from some hearings in which Congress called people to come and talk about the benefits of IFRS, whatever, or the implications, I should probably say, of IFRS. And so, and I'm just going to give you the parties because I knew what they were. And, you know, you could see it in the transcript from the hearings. They say the Republicans said, we are in favor of IFRS because IFRS allows companies to capitalize their research and development, although it wasn't research and development, it was just a development. They allow them to capitalize it. That's going to help grow the economy. And then the Democrats stood up and said, but investors have been harmed by capitalizing research and development, and it should continue as it is now under US GAAP. And so two morals of that story, you know, there are arguments for and against, okay? The other moral to that story is if you give Congress something to argue about, what will they do? Argue. And depending on what day of the week it is, they'll be on one side or the other of the argument. Because I've seen that go 180 degrees. You look a little bit later and one side's arguing, wait a minute, who thought that was the other side's argument before? So, okay, question? Quick break, guys. Okay, all right, good. Let's take, those are all good questions. Let's take a quick break though, so that we can not die here. And I'm thinking we will come back. Let's see, let's make it 11 o'clock. I'll give you a 13-minute break, okay? And we'll come back straight up at 11.
Okay.
Okay, guys, I want to go ahead and get started back. Don't forget, I am recording these lectures, notwithstanding the problem that I was having with links for some reason in Canvas. I'm hoping that I'll be able to post these lectures up so you can go back and revisit portions of it. I'll try to remember to pause the recording during the break, but if I don't, you might have to fast forward through that. I remembered this last time, but also I might ask for help to remind me to go ahead and start up again. And guys, you know, I noticed I had 28 people, which seems like about the capacity. Now I'm down to 26. Look, you know, I didn't come to your house and tell you to take the MBA program at San Jose State. You decided to get into this program, and my expectation is that you're going to be attending class and you're going to stay for the class. This is not an undergraduate thing where you float in and out and do what you want. This is an MBA program. This is an expectation that, you know, you're intensely involved in this material. So I am watching who's coming, who's going, and making note of that. So make sure you're, you know, and I'm preaching the choir if you're here, but make sure that, you know, you're realizing that this is not a thing where, oh, I'll come to class sometimes. This is not the bachelor's. This is the MBA program. Okay, you need to be here. Okay. All right, good. So let's go ahead and let's continue on. Are there any questions before we jump into the next couple slides here? Okay. Okay, good. So let's go ahead. Okay. On, please. I tell you, these technical things are starting to get ponderous here. It's really going to mess up my ability to do things the way I want if my clicker is going to decide to stop working. Let me try one more time, guys. Yes. Okay, well, I'm just gonna have to fight through this. Okay, all right, that's all right. This machine, but just taking a look now at the accounting equation again, and you can see that we have our assets equal our liabilities plus our stockholders' equity. Okay, now notice that the most dynamic part of this, as we've talked about, is our stockholders' equity, and particularly the retained earnings part of the stockholders' equity, right? And so you look at this and they show you revenue minus expenses minus dividends is how we're going to calculate the retained earnings. But remember, we report what on the income statement? What goes on the income statement?
The income.
Net income.
Good. Net income is on the income statement, right? Good. That's revenue minus what? Minus expenses gives us the net income. And then we take that over to the statement of, and I'm going to abbreviate pretty consistently, retained earnings here, in which we'll have the beginning balance, say 0, okay? And then we will add our net income, which say our net income was 3, right? So net income comes over and we report it on the statement of retained earnings, and then we subtract dividend. And we subtract the dividend and say $1 just to have a number there. And that then gives us the ending balance. And the ending balance is what? In this example, $2. Okay. So when you look at expenses and dividends, yeah, they both have the effect of what? Of reducing my retained earnings. But it's important to know that where we report those on the financial statements is different. We report expenses on the income statement, right? And we flow over the net income to the retained earnings. But the dividend, remember, we put the stopper out of the piggy bank and we pulled that money straight out of retained earnings. Therefore, dividends are reported what? Straight on the statement of retained earnings. So even though they have the same effect, they are treated very differently in how they're reported in the information that we give to our investors and creditors. We report what? Expense on the income statement. Dividends, we show that as money that we pulled straight out of the piggy bank, right? As we divided our net income. Question? Okay, good. So let's just go ahead now, and we've already looked at this, but let's review it again now that we have our little lemon, business. And now it worked. Don't ask me. We're now going to go through this again, in which we have our income statement. And when we look at our income statement, we have what? Revenue minus expenses equals our net income. Net income rolls down to here's my little drawing that you're going to get sick of here pretty quick, I'm sure. There's my little piggy bank, right? And so what happens? We come over and we have the beginning balance. We pull our net income down to the retained earnings. We subtract our dividends. We pull a little stopper right out of the piggy bank, pull that 1,300 out, and whatever's left in the piggy bank continues to be my retained earnings. So if I don't pull it out as a dividend, I've retained the earning, haven't I? So we call it retained earnings. Okay. Okay, good. And you come over, and of course, retained earnings, as we've seen, rolls down to the balance sheet so that my balance sheet balances assets equal liabilities plus stockholders' equity. And when we plug the retained earnings in there, the balance sheet balances, right? Question? Okay, good. And we looked at, we'll look at the statement of cash flows later. When I say later, after the first midterm, so don't worry about that now. But when we looked at Apple's financial reports, they were set up the same way. It was just gigantic numbers, right? I mean, Tim Cook would cry if you told him you only had $8,050 of cash. Okay, but the numbers were bigger, but essentially the same concept. All right. Okay, good. So let's go ahead. And this exercise, I think, is kind of useful, and it's going to show us how we have various transactions in this company, and then how those various transactions affect the accounting equation that we've been working with here today: assets equal liabilities plus stockholders' equity. So let's just go ahead and go through this together, okay? And this is not a bad thing for you to also, I've downloaded the slides, or I've posted the slides in Canvas, and you may want to just go back to these slides and see if you can determine, do the exercise again on your own, because I think it is good to see how different transactions affect the accounting equation. Now, the way they're doing this is sort of like an Excel spreadsheet. And so now we're getting a little more sophisticated than all that scribbling I had on that little example with the lemons. By the same token, even this approach is not the approach that companies use to record information for their financial reports. we're going to start to see there's a very formal process that has been around since the 12th century that we will use to keep this equation in balance. Okay, so this is more just showing you, well, if you do something on one side of the equation, you're going to have to either do something on the same side of the equation that counterbalances what you had done on that side of the equal sign, or you're going to have to do something on the other side of the equal sign to keep this thing in balance. Okay, so let's just start to take a look at these, okay, and jump in with questions, or jump in to answer my questions as I ask you. We've got this Ray and Barbara Neal decide to open a computer programming service, which he named SoftBite. And I don't understand if it's Ray and Barbara together, why he got to name it. Seems like he would ask her too, but he decides to name it SoftBite. And on September 1st, 2015, they invest $15,000 cash in exchange for stock. So we put lemons, right? And we took back the stock. They're putting cash in and they're going to take back stock. So they're putting cash in the corporate accounts, and now they're going to have this stock sitting here, right? And that stock, they could then turn around and sell it to somebody else. It's of no consequence of what happens with the company, right? Other than the fact that there'd be new owners at that point, okay? But if $15,000 cash goes into the corporate accounts, will our cash increase? Will our accounts receivable increase, supplies increase, or equipment increase, do you think?
Cash increase.
Good, cash will increase 15,000, right? So now we're gonna have to do something of equal on the other side of the balance sheet to keep this in balance. So what do you think is gonna increase on the other side of the equal sign? Something went up here, something has to go up here to keep this thing in balance, doesn't it? So what do you think is going to increase on the other side?
Stock.
Good, the common stock got to increase 15,000. Excellent. Question? Okay, good. Let's take a look at the next transaction. Number 2, we purchase equipment for $7,000 cash. Now, if you purchase equipment for cash, is my cash going to go up or down?
Down.
Good. Cash is going to go down. So something is going to have to be done on either side of this equation of this equal sign to keep this thing in balance. What do you think is going to happen?
Expenses.
Well, does
No.
equipment have a future economic benefit, you think?
Yes, equipment's gonna go up.
Yes.
So can it be an expense?
No.
So what's going to happen?
Wouldn't it stay the same and the cash would just relocate to the equipment because it's still an asset?
Well, yes, but I wouldn't articulate it that way. Yes, the cash is going to go down and the equipment is going to go up, right?
Right.
Okay, I mean, I have less cash, so I'm going to decrease my cash because I only have 8,000 cash, but now I got 7,000 of equipment, but the equation stays in balance, doesn't it?
Yeah. It does.
Okay. Okay, good. Question? Okay, good. We come over to the next one and we purchased supplies on credit. Okay, now, very important. If you read a description of a transaction at this early stage and you don't understand how I knew that this was on credit and therefore meant that they weren't going to pay the cash out right away, that's what that means, right? You have a credit card, you use the credit card, you don't pay for it right away, right? So you get something on credit, means you're not paying for it right away. But if you see a description, you're like, John, how did you know that that was not for cash and that was on credit? You need to ask me that, because I've been looking at this stuff for 30 miserable years. Okay, just kidding. For 30 years, I've been looking at this stuff and I miss those subtleties because there's almost a subconscious part of my brain that's registering that. And so if you don't see it, ask me, okay? But here they say they purchase on credit. That means that they're not going to pay for it right now. And they get some computer paper and they tell us it's going to last several months. Why are they telling us it's going to last several months?
Not an expense.
Good. It's not an expense. It's not expiring. It's going to have future economic benefit, right? Very good. Okay, so what should I increase here on my asset side then?
Supply should increase.
Supplies,
Supplies are going to increase. Good. What's going to happen on the other side?
cash.
Accounts payable will increase by 1,600.
Yeah, exactly. Why would cash be involved? I'm not paying this till later, right?
Yes, correct.
Okay, so what happens? My what? My supplies go up, but now I have a liability called accounts payable. I'm saying it funky like that on purpose. I have an account payable. Did the equation stay in balance?
It does.
Okay, all right, good. Let's look at number 4, service provided for cash. So I provide a service and someone hands me cash. If someone hands me cash, will my cash go up or down?
Up.
Cash gonna go up. Something's got to happen on the other side of the equation, doesn't it?
Yes.
What's gonna
Retained
go up on, huh?
retained earnings should increase.
Well, yeah, that gets a little confusing because they're putting revenue minus expenses minus dividends under retained earnings. But of the elements that are under retained earnings, which one do you think is going to increase?
Revenue.
Good. Revenue will increase what? 1,200, right? Therefore, retained earnings goes up. Because
Yes.
retained earnings is revenue plus expenses minus retained earnings, okay? I mean, minus dividends equals retained earnings. So if I were to prepare my statement of retained earnings right now, guys, and I know you're getting tired of the silly drawing, and I'm just gonna keep doing this until, we're past this first stage. But what happens? Beginning balance for Ray and Barbara and Neil, because they just started the business, was 0. If I make up my income statement right at this moment, my revenue is, what was it, 1,200? My expenses are what? Right at this moment, my expenses are 0.
Yeah.
Net income is 1,200, so my net income would be 1,200. And right now, the dividend is 0. So the ending balance in retained earnings is 1,200, isn't it? So the revenue, sure enough, did increase the retained earnings, and they put it under the heading retained earnings. But more specifically, the thing that went up was what? Was the revenue.
Why does the
Okay.
$1,200 go in cash and not accounts receivable?
Because it says I received cash.
But aren't they paying for a service? Wouldn't that,
It's what they pay in, so it doesn't matter if it's if they're going to receive something. It's a matter of, do they pay in cash or do they pay in a receipt?
gotcha.
Okay, I think maybe I better answer some of these questions, guys, because I'm not liking that answer. If you receive cash, does your cash go up?
Yes.
So why would you want to put it in another account called accounts receivable?
Maybe I'm not understanding what accounts receivable is then.
Well, again, guys, okay, if you go and you play tennis and the coach tells you to do this, you don't do that, do you? I'm telling you, you got to follow what I'm saying to you. Did your cash go up if someone
Yes.
gives you cash? Then we have to reflect that as an increase to what account?
The cash.
Cash.
Okay, that's it. Close off the rest. Okay, you got it. Sometimes you gotta suspend. Here's what happens. I'm experiencing this in my class at Stanford. In college, you get so bombarded with bullshit that after a while, you feel like you gotta think something more. Meanwhile, most of what we do in business comes down to something as simple as this, and then everyone tries to impress each other by getting real sophisticated with how they talk about things. Okay. So I want to keep us like this right now so that we don't get our minds just cluttered with things or pulling in other things and stuff. Okay. So I'm going to be a little bit of a tough coach on you. Remember, I said this is the boot camp part of the course, right? Then we can start doing some of those other things once we know we've got a good, strong foundation. So again, if your cash goes up, what account do you want to increase?
Cash.
Cash, and that's what we do. Okay, good. Okay, and since we provided a service, yeah, our revenue went up. Okay, if our revenue goes up, our retained earnings goes up, the equation stays in balance. Assets equal liabilities plus stockholders' equity. Good. Okay, all right, let's go ahead and let's take a look at this next one. And we purchase advertising on credit. Now, are we going to pay this upfront?
No, it's credit.
It's going to go to, since it's on credit, it's going to increase my liability. My liability, I'm going to increase my account payable, right? So
Yeah.
we know that what, $250 is going to show up in accounts payable. Okay, I'm going to go ahead and write it there now, just so that we know that's going to increase my account payable, right? Now, let me explain something about advertising. And this is probably not the best example for them to bring in right now, but I'm going to go ahead and do it since it's here. You look at advertising. Do you think advertising has a future economic benefit?
Yes.
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 Yeah.
Right? But we really know if it has future economic benefit? I mean, I listen to some advertising sometimes and it's so annoying that I'm like, even if this product was good, I'm not going to buy this now because this thing is so annoying. So we don't really know, although I think that that's what advertising is trying to do, annoy you. Okay, but we don't necessarily know if it's going to have future economic benefit. We don't know if the future economic benefit will come this year or in another year. Maybe we put out an advertising campaign because we're trying to spend end of year holiday, Christmas time, whatever, spending. So, and here's our ad. They like our product, but they said, but I already bought my sweetheart that I know I'll get them that for next year. I'll go and get it for Valentine's Day or something, right? So we don't even know, well, when will it give us future economic benefit? And just like research and development, FASB says, when you have that much doubt as to whether or not you really have future economic benefit, what do you do with that item? If you don't know, research and development, FASB's logic was, we don't know. Maybe your research and development's going to crash and burn like many research and development projects do. So we make you expense research and development. So if we don't know whether or not something's going to have future economic benefit, what do we do with it?
We expense it.
Consider it as expense.
We consider it an expense. Very good. Okay. And so that's what's going to happen. Now, this thing is going to do what? It's going to increase our expenses. Our expenses went up. So now our what? Our net income will go down. So our retained earnings will come down. So let's do that one more time now. So we had what? We had revenue of 12. Now we have expense of what?
250.
250. So our expense went, before we expensed this research and development, our expense was zero. I mean, advertising, research and development being the same way. Our expense was zero, wasn't it?
Yes.
But now, because we did this, now our expense is what? It went up from 0 to 250, didn't it?
Yes.
And if your expense goes up, then your net income comes down. What is that now, guys? Help me out. I'm not good.
950.
950, thank you. What you're going to see is I'm not good with math at all. I'm horrible with math. People say, well, how'd you become an accountant if you're not good with math? I became an accountant because once you give me the numbers, I know what to do with them. Okay, but I'm not good at calculating numbers in my head. And so what happens? We sit here and we do our little piggy bank here, okay? And we have what? Oh, I just realized something. Rather than draw the whole pig, I'll just draw the nose. And then you know that that's the pig, right? So we have what? We have the beginning balance, since they just started business was 0. Good, we have net income now of what?
950.
950. Right now, there's no dividend, so the dividend is 0. And so the ending balance is 950. So what happens? Expenses go up. That, and the reason they're showing it as a subtract is that reduces my retained earnings because my net income comes down, right?
Mm.
Okay. Question? Okay, good. Let's look at the next one. So now we have service provided for cash and credit. So we provide 3,500 of programming services for our customers. The company gets 1,500 cash, and then I'm going to bill the customer for the remaining 2,000. Would you do something like that? Someone says, hey, yeah, okay, I like your services, 3,500, that's a fair price. Do you mind if I only give you 1,500 up front and then I'll give you the other 2,000 later? Would you do that?
Yes.
Yeah, okay, good. So if someone hands me cash, what account's going to increase?
Cash.
Cash will increase 1,500 because they gave me that much cash, but the remaining what? 2,000, I'm going to get that later. If you're going to receive cash later, do you have a future economic benefit?
Yes.
Yes, you do. It's the next best thing to actually having the cash. We call that accounts receivable because they're going to pay me 2,000 later. So my receivable is going to go up 2,000, and I provided the revenue, haven't I? So the revenue goes up, the full 3,500. So very important thing to note here, guys. You know, this is, I want to pause for a second because this is a very important thing to learn right here. Notice that what causes me to recognize revenue is not the receipt of cash, but what? The providing of the service. I provided the service, and even though I didn't get all the cash, I took all that service revenue, and then the rest of that cash is going to come in later. That's okay. I still took the full revenue, didn't I?
Mm-hmm.
So then, providing an additional context, if we look back at the lemon problem, the guy who runs the fertilizer store that second year would still show that $7 revenue immediately when we picked up the bag, even though we hadn't paid him.
Correct. He would have increased his account receivable and increased his revenue, even though we weren't going to pay him until the next year. That's correct. Yeah? That answer satisfied you?
Yeah, 100%. Thank you.
Yeah, okay. Yeah, if you ask me a question and it's good, just go, that way I know you're good or whatever. So I don't keep thinking maybe you're just confused. Okay? Especially when we're not seeing each other face to face. Okay, good. Let's go ahead then and let's take a look at this next situation here. SoftBite pays following expenses in cash. And we've got some store rent, we've got some salaries, we've got some utilities. If you pay something in cash, does your cash go up or down?
Down.
Down. My cash is going to go down, and what's going to happen? My expenses will go up. If my expenses go up, what happens to my retained earnings?
Goes down.
Goes down.
Expenses go up, net income comes down, retained earnings comes down. Good, excellent. Okay, and so the equation will stay in balance that way. And they went ahead and just listed each one of those expenses separately, whatever. Question? Okay, good. Transaction number 8. We pay this bill. when you pay a bill, does your bill go down or up?
You pay a bill.
When you pay the bill, does the balance on the bill go down or up?
Down.
Down.
Down. So this account pay a bill is gonna go down, isn't it?
Mhm.
Yes.
When you pay your bills, does your cash go up or down?
Down.
Down.
Down, sometimes very sadly, right? Okay, so what happens? The cash comes down, the accounts payable comes down, liability comes down, the equation stays in balance. Very important. Notice, guys, what caused the recognition of the expense was the fact that what? We determined that the future economic benefit had expired, just like the fertilizer, not the payment of the cash. That's not what generated the expense. What generated the expense was what? Was the payment of was the future economic benefit expiring is what generated the expense, not the payment of the cash. Now here, if the future economic benefit is expiring as you pay, then sure, then you could show that expense as cash, just like the first year with the fertilizer, right? Okay. Okay, good. Let's take a look at the next one. And, oh, I see why it didn't change yet. SoftBuy received 600 in cash from a customer who had been billed in the previous transaction. So now they're paying us. If somebody is paying you, is your cash going to go up or down?
Up.
Up. And what's going to come down?
Accounts receivable.
The accounts receivable, right? Now, instead of owing us 2,000, they only owe us what? 1,400? This is why they invented accounting, guys. Back in the 12th century, what? If you owed somebody money and you didn't pay them, they had the right to take you and make you row in the bottom of a ship for 20 years until you paid that money off, right? So people had to keep track of what they owed people and what people owed them and all that kind of stuff, right? So really, that was the whole point of accounting in those days, was keeping track of receivables and payables, right? Okay. Okay, good. You come over and you take a look at the next, and I don't quote me on the history. My teacher said that in Venice they threw you in jail if you didn't pay, but I'm just saying, this idea of, well, if you don't pay your bills, you file for bankruptcy, and then it makes it hard to get a credit card after that. That's relatively new. Okay, you go back to even the early parts of the last century, 1900s, there were such thing as debtor prisons. They locked you up if you didn't pay your bills and stuff. So, it was kind of a big deal back then. It could actually mean you're surrendering your freedom if you didn't pay. Okay, all right, good. Let's go ahead and let's take a look. And the corporation pays a dividend in cash. So what happens? We're going to reach into the corporate accounts and we're going to pull $1,300 out and pay it to our owners. Is the corporate account going to go down, the cash account?
Yes.
Down.
Yeah.
Cash account's going to go down. And what else is going to come down?
Earnings.
Common stock.
What is this?
It's the called retained earnings.
There's the retained earnings. Retained earnings has a beginning balance of what?
0.
So in this case, by now, I'm going to add my net income. And by now, I've got what? If I sit here and I look at my revenues, revenue is going to be what? 1,200 plus 3,500?
4,700.
What is it? 4,700?
Yes.
Okay, so when I make my income statement, revenue, what'd you say? 47?
Yes.
Is 47. Somebody got an expense number for me? The dog had it. 250 plus 600 plus 900 plus 200.
1950?
1950, 1950, like that.
Oh, I just did that in my head. Let me make sure.
Oh yeah, we don't do anything in our
Yeah,
head here, guys.
That's
God
right.
invented calculators for this class. Okay, what is it? God looked down at accountants and said, "Oh no, this is not right. They need calculator." Okay, so that's why they invented the calculator. So net income is how much? Did we get a second on that 1950?
Yeah.
Okay.
2750.
2750, good. So my what? My net income is 2750. And then I pull the plug out of the back and I subtract
Dividends,
dividend. Good. How much was the dividend?
1300.
1300. And so the ending balance in retained earnings is how much?
1450.
1450, you say?
Yes.
Okay, good. So there's the 1450. And so the dividend does what? Dividend acts like an expense, and that when the dividend amount goes up, the amount of dividend they paid, that reduces my retained earnings, doesn't it? But instead of reporting it on the income statement, I report it straight on that statement of retained earnings, don't I? Okay. And guys, if you are ever trying to figure out how to calculate the balance of retained earning, it's beginning balance, add net income, subtract dividend, ending balance. BASE spells base. Just remember your base, right? Beginning balance, add the net income, subtract the dividend, ending balance. Question? Okay, good. All right. And so my dividend reduces my retained earnings, but the dividend amount went up because I have to report it right there as a dividend of 13. Okay, all right, good. And then you can see the numbers, and maybe I just should have hit the next slide rather than sit there and make us calculate that. You can see the 4,700 for revenue minus expenses gave us the net income. And then the ending balance for my stockholders' equity is this, what, this 1450 plus the 15,000 of the stock for the entire stockholders' equity. Okay, so you come over and let's look at those financial statements one more time. Revenue 4,700, expenses 1950, net income 2,750, beginning balance, right? Beginning balance in the retained earnings plus the net income minus the dividend gives us the ending balance 1450. Balance sheet, our retained earnings comes over to the balance sheet, and then there's my different accounts. And if you go back to the little spreadsheet, my cash was what, 8050, my accounts receivable is 14, my supplies are 16, equipment is 7, liabilities are 6, common stock is 15. Once we issued that stock, that didn't change anymore. Okay, and then the retained earnings we've calculated above already, and so there's the balance sheet.
So we bought those $1,600 in supplies. If we had used 10% of it over the term, we would minus 160 from the supply. And on the other side, that's when it would become an expense.
Correct.
As we used it.
As you use it, as the future economic benefit expires. Once you print all over that paper, future economic benefit is expired, right? Okay. Okay, good. I think that's the main things for chapter 1. This is, I probably need to take this slide out at some point because this is old. and not relevant to the Bay Area, just some kind of different salaries for, finance and accounting types. And, I'm here to tell you that if you told the chief financial officer of Apple that that was his salary, he would weep, he or she would weep openly. Okay, I mean, they make a lot more than that, I'm sure. Okay, but I put this in there originally because when I teach introductory, I'm often trying to, let some folks who are maybe, majoring in hospitality management, that they might want to think about accounting as another opportunity. Okay, question? Okay, good.
Oh, sorry. I actually
Yeah.
had a quick question, another hypothetical one. I'm sorry.
No, it's fine.
So like a lot of the times when you hear like earnings reports, you'll hear companies say, oh, we have X, Y, Z in the backlog, right? So when they have something in the backlog, would we see that in the retained earnings?
I'm not sure what they mean by the backlog, so I would be speculating a little bit here, but let me go ahead. If I have received money in advance of actually providing the service, so now you've given me the money, right? But I haven't provided the service yet. If I don't provide you the service, do I have to give you the money back?
If you provide me the service, do I have to give you the money back?
No, that's not what I said.
Oh, sorry.
You've given me the money.
Okay.
I haven't you provided the service yet.
Mhm.
If I don't provide the service, do I have to give you your money back?
Yes.
Yeah, otherwise Judge Judy gonna tell me to do it, right?
Right.
Okay, they're gonna send me to court and I'm gonna have to give you that money back because the courts don't have no sense of humor about taking someone's money and then stiffing them on whatever you said the product or service was gonna be, right? So they're gonna tell me I have to give the money back, right? If I potentially have to give money back to somebody, do I have a bill?
Yes. I'm not sure.
Well, when you take service from someone and you haven't paid them yet, that's a bill, right?
Yeah, that's right. Yeah.
Okay, well, if you take money from somebody and you haven't provided the service, you kind of have a bill, don't you? If you don't provide the service, you got to give them the money back.
Right.
Okay, so what the accounting standards say is you have an unearned revenue. If someone gives you cash before you earn that revenue, before you provide the service, therefore you have a bill, right? You have a liability, but we call that liability unearned revenue.
Gotcha. Okay. So it's a liability. Another factor of liability is unearned revenue.
Correct. Another element of liability is unearned revenue. Now, and we're going to get into this more, I don't know about today now, but we're going to get into this more, but just to expand on that a little bit. Analysts tend to look at unearned revenue as a favorable liability because what is it saying?
Saying that you have business in the near term future and you've already received money for it.
Yeah.
So it's like like you don't have to pay interest on it. So it's like free money in a sense.
My service is so good that people give me money in advance for it, right? People are handing me money now to make sure they got my services in the future, okay? So that could be what they mean by a backlog, and that we already had collected some revenues, not revenues because they're unearned revenues, but we've already collected some future economic benefit cash, and we're going to be providing those services going forward. The other thing they could mean by backlog, and now I remember where it was that I heard the problem with the computer chips. Although, you know, Tesla's always, we have backlog, and all the news stations carry it. And I wonder if they're not paying for that news story. I mean, there's nothing that says that advertising has to be done during the commercial break. Okay, they could still give money to the TV station to carry a news story that says, "No, we can't get them, you know, Teslas are really hard to get," so that everybody, oh, I gotta have one. But anyway, Tesla always says there's a backlog, but they're saying now that their backlog in being able to deliver orders is because the price of the computer chips is going up, and that's creating there's a shortage of supplies. They didn't say the price is going up. There's a shortage of supply of computer chips. And of course, economics would say, well, if the supply is short, then the price would go up. They didn't say that part. They just said, you know, there's a backlog in their orders because, you know, the amount of chips are available. And the more I think about what I'm saying, why would that be newsworthy? Why is that a news story? I'm serious. Why is that a news story?
Because computer chips are the backbone of pretty much everything that we do today.
But why is the shortage of Teslas availability a news story? They want to talk about shortage of computer chips, and they could say there's a shortage of computer chips, and so everything that involves computer chips might be a shortage. Why is it specific to Tesla? Why is that a news story?
Tesla bears.
Huh?
Tesla bears.
What
Find
is it?
news stories. Like
Say what?
compare, like in a market, bull and bear market, Tesla bears. Like could possibly be like promoting negative information.
Okay, I still don't see why it's a news story, but anyway, maybe there's something newsworthy about it. I just feel like, well, you know, why not talk about shortages in computers because of the computer chip shortage? Anyway, okay, let's move on. All right, come over. And what this gives you guys is an example of how the midterm will work, although I'm not going to put a ton of questions from chapter 1. It's worthwhile to go through this. And remember, when we met the other day, I said that the questions for chapter 1 midterms I embedded in the slides, and that's the only time I do that. Going forward, you will see the questions inside of a Word file. So going forward, you should go ahead and find the separate Word file that'll give you the example questions for the midterm for the chapters going forward 2 and 3. Okay, all right, but let's take a look at some of these, and we say, which of the following is not an external user of information? Okay, not an external user. So are regulatory agencies external to the company?
Yes.
Right, obviously, okay. Customers are external. Sometimes I get students that say, well, wait a minute, customers aren't external. Well, look, Nordstrom's the company, isn't it? And if you're a customer of Nordstrom and you're sitting there at the counter, and let's say there's nobody managing that counter while you're waiting there, and the phone starts ringing on that side of the counter, do you go to the other side of the counter and say, this is Nordstrom? No, because you know you're external. You're not part of Nordstrom. You don't answer the phone, right? Okay, so customers are external to the company, and they are what? They are one of our primary users, aren't they? I mean, not one of our primary users. Customers are not one of our primary users, but they are external to the company. How about investors? We had a slide where we called them out as external, and they are one of our primary users, right? Investors and creditors are our primary users. Okay, okay, good. So which of the following is a primary user? I just told you the answer to that. Investors and creditors, right? Okay. The SEC, IRS are regulatory entities, but they are not, and they're external, but they are not primary users. Primary users are only investors and creditors. Okay. Okay, good. Number 3, and I don't know that when we had our discussion the other day that I specifically called this process out as the answer to this question, which is convergence. Okay. But remember, I said that everybody thought the US was going to go over to IFRS, and then we didn't go over, the US did not go over to IFRS, but they agreed that they would create a joint conceptual framework. And when they issued standards, they would both be issuing from the same conceptual framework. And so as a result, the standards of the two standard setting bodies would become more and more similar. However, there will always be differences between US GAAP and IFRS. Well, that process of bringing those sets of standards together was called convergence. Convergence, okay? When two cars get on the freeway, they're all converging into the same lane or whatever, hopefully not at the same time and causing an accident. But when the lanes on the freeway get less, that's called, that's a convergence process, right? Okay.
I have a question. The customers, are they not primary users?
They are not primary users. I misspoke because I was jumping to, I knew investors was coming next, and I jumped what I wanted to say about investors to the creditors. Creditors to the customers. Customers are not, let me just say this carefully. Slow down, John.
So we have more investors than customers?
Stop. I'm just going to tell you what it is. Investors and creditors are primary users. That's it. Say that.
Investors and creditors are primary users.
That's it. Nobody else is a primary user.
Okay, so I'm just not gonna think of the customers then.
Customers are customers investors?
No.
Are they creditors?
Nope.
Then they're not primary users.
Okay.
Yeah, I misspoke before. So investors and creditors are primary users. Nobody else is. Customers are external. The SEC and regulators are external, but they're not primary users because they're not investors and creditors. Right? Hello?
Yeah.
Yeah, okay, okay, good. Okay, all right, let's go ahead and let's take a look. Liabilities would not include, is notes payable a liability? Is notes payable a liability?
Yes.
Yeah.
The accounts payable a liability?
Mhm.
Is salary and wages payable a liability?
Yes.
Yes.
Is cash a liability?
No.
What is it?
And ask.
Asset.
Liquid asset.
Good. Good. Okay, excellent. Okay, the origins of accounting are generally attributed to the work of, and this is, I mentioned this Luca Pacioli, and I'm not going to ask you this. I mentioned that 12th century Venice, he wrote about it. They always say he's the father of accounting. Commerce going on in Venice at that point in time was using it. He wrote about it in his journals. I mean, he probably also wrote about, how the streams flowed eastward, whatever the hell was going on at that time. It wasn't just limited to discussion of accounting. Okay, good. So Martin Company, number 6, purchased land in 2007 for $290. Okay, in 2013, it purchased a nearly identical parcel of land for $460. In its balance sheet, Martin valued these two parcels of land at a combined value of $920. So if you look, what Martin did is took 460 for the 2007 land and 460 for the land that they got in 2013. Right? And then they combined those two, and that's how they got the 920. Is that what you're supposed to do?
No.
Is that what you're supposed to do?
Not at all.
What they should be doing is what? Leaving that 2007 land at the historical cost, 290, right? And so the total value should be whatever, 290 plus 460, what is it?
750?
Is it 750? Isn't that what they should be doing?
Yeah.
What did we call that? This was last time. We called it the historical cost principle or cost principle, right?
Yes, sir.
Okay. Okay, good. Let's take a look at this next one. The private sector organization that develops accounting standards, the FASB. This question we've already answered. It was so great, I had to put it in there twice. Okay. Okay, good. Andre Dickinson, owner of Andre's Fine Wines, also owns a personal residence that costs $475,000. The market value of the residence is $625,000. During the preparation of the financial statements for Andre's Fine Wine, the accounting concept most relevant to Andre's home is what? Should Andre include the business as part of the, his residence as part of the assets of the business?
As long as he's using it for business, then yes.
Well, if he's using it for business, but they're calling it a personal residence, so it doesn't sound like he's using it for business, right?
Mm-hmm. Sound like he's not.
Yeah. So since he's not, should he include it?
No.
Right. So what happens? The accounting concept most important to his home, a personal residence, is what? The economic entity assumption. He should not combine his personal assets with that of the business. I mean, if he puts them in the corporation, they become the corporation's assets, and then they would be subject to some sort of claim by the creditors, et cetera, right? So I think Andre would be making a mistake if he actually put them in the corporation. Now, if he wanted to use them in the corporation, what he could do, since the corporation is a separate entity, he could charge the corporation rent for the use of part of his home, right? So that the home stays what? The home stays as his personal asset, and he, Andre, even though he runs the corporation, is simply renting or leasing that part of his house, whatever, to the corporation. And that would then become a rent expense to the corporation, right? And he might like to do something like that because now the corporation is getting a, expense that they can recognize, and he's essentially getting a revenue, a personal income for that rental to his own corporation. Now, if he did something like that, he would be required under the accounting standards to disclose that as a related party transaction, so that the users of the financial statements, other potential investors, would look at that and say, okay, do I want to invest in a company in which other shareholders or primary shareholders are leasing back their personal assets to the corporation? So that would have to be disclosed. Okay, good. Let's take a look at the cost principle. Requires that when assets are acquired, they be reported at what? Their original cost, not all these other things. Okay. The Deuce Company has 5 plants nationwide, total cost 100 million. The current fair value of the plant is 500 million. What should you report it at? 100 million, historical cost principle. Okay. Economic entity assumption requires that the activities of the entity be kept separate from the activity of the owner or owners. Okay, your exposure is limited to whatever stock you've paid for or whatever you've given up in exchange for stock. That's the limit of your liability. Think about it. If you buy Tesla stock or something, you know, stock in the company, and they lose money and you have that stock, do you expect someone to come to your door and say, yeah, you know, Tesla had a bad year, give us your car? No. Well, it makes no difference then if the shareholder is also the person running the company. Go ahead. Did I hear something? No? Okay. All right, good. All right, let's take a look. A small neighborhood barber shop, whatever, it's probably going to be a proprietorship. I use that example in class. A barbershop can incorporate, a small barbershop can incorporate too, and many do. Okay, but so I don't know, just something to realize that we have the idea of sole proprietorship. Owner's equity is best depicted by the following. First off, is it true? Do I have agreement that assets equal liabilities plus stockholders' equity?
Yes.
Yes. Okay, good. So if we're in agreement on that, then do you agree that if I were to take assets and subtract the liabilities, that I would therefore be left with the stockholders' equity? So if my
Yeah.
assets are 100, my liabilities are 40. We put some numbers on this just to make sure we're cool with what we're doing here. Assets minus liabilities then would equal stockholders' equity, right?
Yes.
Okay, okay, good. Liabilities, liabilities right here are future economic benefit. No, that's an asset, right? Existing debts and obligations. Sounding like it, but let's go. Possess service potential. Well, what are things that possess service potential?
PPE.
Okay, we're going to stay away from abbreviations and shorthand here. What are things that possess service potential?
Assets.
Assets, good. Okay, so that's not a liability. Are things of value used by the business operation? Again, that's going to be what? That's going to be an asset. So these other three, A, C, and D, gave us the definition of an asset, but existing debts and obligations, our bills, are liabilities. Good. Okay, good. The accounting equation for this Quattro enterprise is as follows. And we have our assets of 120, our liabilities of 60, our stockholders' equity of 60, and then they purchase office equipment for 15,000. Now this is very similar to that little exercise we just went through. So is office equipment an asset? Does office equipment have future economic benefit?
Yes.
Is it an asset therefore?
Yes.
Yes, it is. So we take that, that office equipment, add it to the 120,000. So we know that we can already get rid of what? A, right? And then if we bought it on account, that is one of those things that you're going to have to get used to. Buying something on account is equivalent to buying something on credit, is equivalent to having a bill for that, isn't it? And let me open an account for you. I mean, you don't have to pay right now, right? Okay. So if we have an account, if we're going to have a bill, our liability is going to go up.
Yes.
Yes.
Good. So we take that and we add that 15,000. So now our liabilities go to 75,000, don't they? Question?
That's right.
Okay.
If we were to have bought it cash, then that A would have been the right answer, right?
If you were to buy a what?
15,000 worth of equipment in cash rather than on account.
If you had bought it for cash rather than on account, then our assets would stay the same at 120. Yes, our liabilities would be 60 and our stockholders' equity is no way affected by this transaction. Correct.
Okay.
Okay, good. Number 17, balance sheet. Why do they call it a balance sheet?
That's the balance.
Because the balance.
Balances.
Because it balances, what balances?
Mm.
What balances? Always.
Assets is equal to liabilities plus stockholder equity.
Good. So does it make sense then that the balance sheet better show assets, liabilities, and stockholders' equity?
Yes.
Okay, good. An income statement. Why do we call it the income statement?
Because it gives us our net income.
Because it shows good, because it
We
shows
report.
net income. Good, okay. And how do you calculate net income?
Revenue minus
Rev-
expenses.
Revenue minus expenses, good. And so net income shows the income statement, therefore the income statement must show revenues and expenses. And we say for a specific period of time, okay, what does that mean? When someone, what is that phrase, a specific period of time mean? When somebody asks you how much money you made, what do you tell them?
A lot.
Like your
After
annual
you
salary?
tell them to mind their own business. Say it was your mom that asked you that. Okay, what do you tell them?
Your annual salary?
Good, excellent. You tell them what you made for the year, don't you? Or what you're gonna make for the year. You don't sit there and say, well, mom, remember when I was 5, you gave me, $5 to help you clean your car, and then you gave me, and when I add it all up, I've made since I was 2 years old when I first got my allowance. No, you do what? You report your income by year, don't you? Okay, so when you think of your income statement, think of your pay stub. Beginning of the year, it's 0, and then you make money. By the end of the year, oh, wow, look how much I made last year. The calendar flips over to the new year. Oh, I got to start all over at 0 again, right? So your income statement is like your pay stub, isn't it? Reports it by year. Your balance sheet is your wallet. Just think about cash. If you have $500 in your wallet on December 31st, you go to sleep with $500 in your wallet, December 31st. You wake up the next morning, assuming you don't have some shady friends that partied at your house on New Year's Eve. What should still be in your wallet on January 1st? You guys must hang out with some-
$500.
Yeah, funky people. There still should be 500 in there when you wake up the next morning, right? I'm thinking you guys don't hang out with people from Hayward, do you? Okay, so there should be what? There should be $500 in your wallet that next morning. So the balance sheet's your wallet, right? If I buy a piece of equipment, the equipment doesn't disappear. It's not a pumpkin. It doesn't disappear at December 31st. It's still there, isn't it? The next morning. Okay, so if you owe somebody money, they don't say, well, since it's a new year, you don't owe me the money anymore. They'll probably be knocked on the door. If you owe them the money January 1st, you're going to get a knock on the door January 1st. Where's my money? Right? Okay, so your balance sheet is like your wallet, right? It has assets, it has liabilities. They don't go away at the end of the year. With my income statement, I turn the meter all back to 0. Because I do what? I keep track of my income by year, right? Okay.
that mean it's fair to think of a balance sheet as like a snapshot, whereas an income statement is more of a time lapse?
Yeah, that's a perfectly good analogy. Balance sheet is a snapshot. At December 31st, click. That's what my situation looked like. Had cash of this, had assets of that, liabilities of that. The income statement is more like a movie, right? Well, the revenue for this whole year, the net income, and that's the end of our movie. Now on to the next year, or the next movie, it's the sequel, which is the next year, right? Year 2, where we have now revenue started at 0 and so on. Yes. Okay, okay, good. All right, let's take a look at this one. And Marissa Company compiled the following. What are, or whatever, Misra's assets? Okay, is revenue an asset? Is revenue an asset?
Yes.
No.
No, revenue is revenue, not an asset. Assets are assets. They're reported on the balance sheet. Revenue is revenue, and it's reported on the income statement. Right? Is retained earnings an asset?
No.
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 Retained earnings is part of stockholders' equity, isn't it?
Yep.
Okay. Okay, good. Is equipment an asset?
Yeah.
Yes.
Yeah, got future economic benefit. Good. Are expenses an asset?
No.
No.
No, expenses are expenses. They're reported on the income statement. Good. Is cash an asset?
Yes.
Yes, it is. Are dividends an asset?
No.
No,
No.
they are dividends. They're going to be subtracted straight from retained earnings. They're the money that we pull out of the corporation to our shareholders. Are supplies an asset?
Yes.
Yes, they are. But am I wasting your guys' time? I'm happy to end class whenever you are. Am I wasting your
No,
time?
for sure.
No, okay. Are accounts pay a bill an asset?
No.
No, they're a liability. Good. Is accounts receivable an asset?
Yes.
Yes.
Yeah.
Yeah. Is common stock an asset?
No.
Oh, it's stockholders' equity. So if you add these up, it's 125,000, right? Okay, good. I'm happy to end class whenever you are, guys. If I'm boring you because I hear this, oh, I'm happy to end it. Guess what? They send a check to my house, whether we go to full time or not, just in case you didn't realize that. Okay. So, if you're bored, I don't know what to tell you. Okay. Get used to it. You wanted to be business majors. I mean, if you wanted, something interesting, you should have studied history or something. Okay. All right. Let's go ahead. Let's take a look at this question. Okay. And this one is taking the same information that we saw a minute ago, but now they're asking me something different, but this needs to show 2013. That's a typo. It's not 2011, it's 2013. Okay, and they give me basically information as of December 31st. December 31st is the beginning of the year or the ending of the year?
And
Okay, that's the end of the year. Okay, good. So we have the end of the year, and then they tell me some information about retained earnings at the 1/1/13. Is that the beginning or the end?
Beginning.
Good, that's the beginning. So what are they going to do? They're going to sit here and they're asking me about stockholders' equity. Stockholders' equity is comprised of what and what? What two accounts constitute stockholders' equity on the balance sheet?
Common stock and retained earnings.
Good, common stock plus retained earnings, right? So they're asking me what should be the balance, when we combine those two. And the only thing they tell me about common stock is that it was 40,000, and they don't talk about any more issuances of stock or anything, right? So I have to know that 40,000 is going to be part of the answer to this question, right? They didn't say anything else about common stock. So now my job is to analyze to see what happened to the retained earnings part of this stockholders' equity, right?
Yes.
Okay, so what happens? I sit here and I know that if I'm trying to analyze retained earnings, I should do what? I should do the beginning balance.
Mhm.
Did they give me the beginning balance?
Mm,
Yeah, it's
Yeah.
The beginning balance is at the start of the year, 1/1, whatever this thing is, 13, right? So that's 30,000.
mm,
Then I need, right? Then I need to add something. What do I add?
Income.
I have to add net income. Net income is what? Revenue. right?
Minus
I'm just picking the numbers
expenses.
up, minus expenses, right? Okay, good, gives me net income of 45,000, right next to the word net income. Okay, good. And then what do I subtract?
Dividends.
Good. I have to subtract the dividend. Dividend, did they tell me anything about dividends?
Mm,
10,000.
Good. Dividends were 10. I subtract that. So beginning balance of, and I wrote the same thing over here, 30 plus 45 minus 10 gives me 65. But that's just the retained earnings. I have to, again, remember to add in what? The common stock to get the full stockholders' equity. Answer is C, 105,000.
Makes sense.
Okay, easy enough. Now, I emphasize that I'm not going to give you a lot of chapter 1 questions. You can expect questions on your midterm that would require you to be able to do this type of an analysis here. Question?
Wait, sorry, could you go back and I didn't catch how you got the 105. I was stuck on the retained earnings. So your retained earnings is your beginning balance, which was 30K. And then your net income is revenue minus expenses, which is 45K. So that two combined is 75K. And then you subtract the dividend, which is 65K.
Right.
And then you add the common stock, which is
I had to
40K.
add
Okay,
the
sorry.
common stock because this question asked me the entirety of stockholders' equity. So not only was it asking me, do I know how to calculate the ending balance of retained earnings? Do I understand that together retained earnings and common stock constitute the stockholders' equity?
Gotcha. Okay, sorry. I was just one
Yeah.
step behind.
No, that's fine. This question, I guess I like to ask more direct questions, to be honest with you, on my test. So if I gave you this, say, the same back pattern on the exam, I would just ask you, what's the ending balance of retained earnings? I don't like questions for our purposes that have some trickery in them. When I initially, chose this question to present to my class, I'm coming off of years of teaching the CPA exam. CPA exam will do this kind of stuff to you and much, much more to get you to kind of have to show that you can. What the CPA exam is doing is not only testing your knowledge of the material, but remember the CPA gives you a license to audit financial reports. And when you audit financial reports, you may or may not have a client that is completely forthcoming with all the information you need to make the proper judgments as to whether financial statements are fairly prepared. So part of what the exam tries to do is test your ability to kind of massage information to pull out what you need to be able to answer the question. So they're testing that ability at the same time. And so they tend to introduce this kind of ambiguity and much, much more, frankly, on the CPA exam. But I've learned over the last, 6-7 years, that's not necessary for our purposes when I test you. So I might show it to you this way, just so you get that, a little bit of that flavor for what, a tougher question might be. But on the exam, I would just ask you more directly, what's the retained earnings?
Awesome. Thank you. Appreciate you going easy on us.
I'll try. Wait till the first test before you declare that.
That's true. That's true.
I'll try not to kill you. I swear, guys, I'm not here to mess up anyone's GPA. I'm not here to give you, I have a little bit of criticism of some of the master's programs, because I think as a society, aren't we realizing that there's more to life than just ridiculous amounts of work and never ending amounts of work and sacrificing our entire well-being to work? Aren't we starting to realize that? So why do we have master's programs that seem all about giving you just an unmanageable amount of work to prove to people that what, you're a good slave? I don't think so. Okay, so I'd much rather give you something that you can handle, give you enough stuff that you can take away a few things, you can remember a few things, you know what the course was all about. But that kind of is going to involve this up front, where I'm going to seem a little mean sometimes when I kind of don't call it that, call it this, because I need to do that so that we can get past all that, and then we can start to kind of add some different knowledge to this and get out of here with an A. That's the goal. So having said all that, I'm done. We're not going to jump into chapter 2. We're going to end it right there. And we will jump into chapter 2 on Wednesday, 6 o'clock. Yeah.
Sounds good.
Yes.
Sounds good.
Okay, guys, I'll post this up. Don't look at it. Don't look at it until Monday. Don't look for it before Monday. Don't look at it before Monday. And we will jump back in on Wednesday. Okay.
Got
Any
it.
questions before we go, guys? I shouldn't end it that quick. Any questions? Concerns?
No.
Okay,
We're
guys.
good.
We'll see you on Wednesday. Have a good rest of the weekend.
Thank you very much.
Thanks.
Thank you.
Thank you.
Thank you.
Thank you too.
Okay.